So, our entries to establish partnerships are very similar to entries to establish sole proprietors. Again, there's just more. Let me put this on pause and write down some facts. Let's assume partner A and B decide to establish a partnership. Partner A contributes $40,000 cash, inventory in the amount of $30,000, equipment with a market value $25,000, and the partnership's going to assume the liabilities partner A has of $10,000. I want you to notice I brought in equipment at market value. Although the equipment might have existed on another set of books at some time, we don't bring in cost and accumulated depreciation of that equipment. We bring in its market value. This is a transaction, a new transaction, and it's recorded the market value of the assets involved. That would only make it sense, wouldn't it? Now let's get on to partner B. Partner B brings $50,000 cash to the party and some office equipment with a market value of $30,000. And they too had this involved in another business where its cost to them was originally $50,000 and they've written off $15,000 so far. I say that because I want you to see we truly ignore it and record at market value. So, let's do the entry first for partner A. How would it look on the accounting records? Partner A brings in cash, so we'll debit it for $40,000. They bring in inventory to sell, the amount of $30,000. And they bring in some equipment that will be used in the business in the amount of $25,000. So we've got the cash, the inventory, and the equipment. Notice I brought it in at market value. The partnership is going to assume some liabilities. Let's say it's accounts payable relating to the inventory. So we'll record that as a liability of the partner, and that reduces the amount of capital that partner A will get because they're also bringing in liabilities. And partners A capital balance will be the difference. 30 and 40 and 25 is 95 minus the 10, so we'll credit partner A for $85,000. There's a journal entry to record partner A. Now, let's make an entry to record partner B's investment. Put this pencast on pause and you make the entry. Come back and let's see how you do. Welcome back. How did you do? We picked up the cash. We picked up the office equipment at its market value and set up the partnership capital account in the amount of 80, the sum of the two assets. How do you suppose partnership balance sheet would look? Why don't you put this pencast on hold and rattle off a little partnership balance sheet and let's see how you do. Welcome back. How did you do? Notice that the balance sheet is just a balance sheet with all the assets combined totaling $175,000, the liabilities of $10,000, and there's an account or a category called partnership equity now instead of owner's equity, and the total liabilities on partnership equity, I had to abbreviate that a little, equals the total assets. So more similar than different. You can also see here how the balance sheet equation changed. It's now assets equals liabilities plus partnerships equity. So, in summary, in our little pencast today, we had a brief overview on the topic of partnerships, what they meant, some pros, some cons. We looked at basic partnership accounting. Good news is it's mostly the same. There's just more people involved. And then we looked at the first entry on how to establish a partnership. And then just for grins, we popped off balance sheet to remind you how to make balance sheets and how really similar they are. The only thing that's changed is you now have partnership equity instead of owner's equity. Thank you for joining me, and we'll move on to further partnership discussions in our next Pencast. So, bye for now.